What's up, guys? If you plan on retiring before 65, let's say 55 or even 60, you know that one of the biggest hurdles you face is paying for your own health insurance. Well, in 2026, all of that is about to change significantly. Today, we're talking about how the One Big Beautiful Bill Act completely changed how we're doing health insurance for clients who retired before 65, and what you can do so that you aren't blindsided with their health insurance costs, perhaps doubling or even tripling. You don't want to miss it. Welcome back, guys. My name is John Boyd, and I'm a certified financial planner and founder of MDRN Wealth. We specialize in helping people retire early before 65. If you want one-on-one help with your own retirement plan after watching today's video, be sure to check out our free retirement assessment in the link below. All right, guys, so in a nutshell, the American Rescue Plan Act that was passed in 2021 removed something called the subsidy cliff. And what this did was it allowed for more individuals to get access to premium tax credits, which reduced the cost of their health insurance through the ACA marketplace. However, the One Big Beautiful Bill Act, what it did was it brought back the subsidy cliff starting in 2026. This means that if your modified adjusted gross income, if it's over 400% of the federal poverty limit, you will be paying full price for your health insurance. Now, I know what you're thinking, probably thinking, what the heck did this guy just say? Well, we're going to be breaking it all down in baby steps, and at the end, we'll tie it all together and give you some ways to hopefully work around this. So first and foremost, if you're not familiar with what the ACA marketplace is, this is often called or nicknamed Obamacare. And what the ACA marketplace allows you to do is it allows you to purchase health insurance on your own without an employer. So if you are someone who is maybe self-employed, or in our case today, looking to retire before you are Medicare eligible at 65, this is critical for you. In addition to giving you a way to obtain health insurance, the ACA marketplace is guaranteed issue. This means that insurance companies must accept anyone regardless of pre-existing conditions. And to top it all off, most people are qualified for some sort of subsidy to make these plans cheaper. So for example, a plan through this ACA marketplace, you might find a particular United Healthcare plan that costs $1,500 a month, and that's the off-the-shelf price. However, with these premium tax credits that exist, that $1,500 a month could be cut down to maybe $200 a month instead. So bottom line is, the ACA marketplace is the primary way to obtain health insurance if you are retired before 65, and to top it all off, there are premium tax credits that could reduce how much you pay for health insurance out of pocket. Now, how do these tax credits work? Well, that's where there's big changes coming in 2026 that's going to greatly affect how much people are paying for ACA health insurance. So in order to understand this, you need to understand what the federal poverty limit is. So for example, in 2025, in most states, if you are a two-person household, so this means that maybe you and your spouse, the federal poverty limit is $21,150. Now that $21,150 is your modified adjusted gross income. So that's going to include things like capital gains, wages, investment income, Social Security, retirement pension income, retirement distributions, even municipal bond interest is going to count. So bottom line is, even if you are retired, your portfolio and how you choose to draw income off your portfolio is going to greatly impact what your modified adjusted gross income is. Now, depending on how much above the federal poverty limit your income falls, based on your household, that's going to dictate how much of a subsidy you get. So without diving into the weeds here, if we choose the second cheapest silver plan on the marketplace as our benchmark, if your income is less than 150% of the federal poverty limit, your expected contribution is 0%. This means that your premium tax credit would cover the cost of your entire health insurance plan. Now let's say your income was 400% above the federal poverty limit. So 400% of the federal poverty limit for a two-person household in 2025 is $84,600. Under current law, even if your modified adjusted gross income was, let's say, $100,000, your expected contribution is still only $8,500. So this is how the math would break down. Your monthly cost for the benchmark silver plan is $708 per month, and that means that your ACA premium tax credit is effectively $721 a month, or $8,654 per year. If you didn't have any sort of tax credit to help you pay for the plan, your health insurance cost would be $1,430 per month instead. So you can see that this premium tax credit can really help cover the cost of health insurance. And on top of that, the fact that there is a cap on expected household contributions of 8.5% means that even if you're well above 400% of the federal poverty limit, that means that there's a strong chance you would get some sort of tax subsidy to pay for an ACA health insurance plan. Now, here is where the One Big Beautiful Bill Act that was signed into law in 2025 completely changes early retirement insurance planning. There are actually a few ways it completely changes things, but for the sake of not overwhelming you, we're going to cover the two primary ways it really changes things. So you should have two sets of numbers in front of you. The set on the top half of the photo is the household contribution percentage for 2025, and that's what we viewed earlier. The set of data on the bottom half of the photo is 2026's expected household contribution rates for ACA health insurance. So for example, in 2025, if your modified adjusted gross income as a two-person married household, if it was $31,700, it would be just below 150% of the federal poverty level, which means that your expected household contribution for a plan is 0%. So that means that your plan would be fully paid for. However, starting in 2026, that 0% ban goes away entirely. And now their expected contribution is now 4.19%. So that would be about $1,300 in an increase in health insurance premiums that this family would pay. Now, in addition to the contribution rates being higher, meaning that everyone across the board is going to be paying more in health insurance, I want you to notice something about the 400% federal poverty limit. Notice how, as part of the American Rescue Act, there was a contribution limit of 8.5% in place. So even if your income is over 400% of the federal poverty limit, your expected household contribution is capped at 8.5%. Meaning that even if you are, let's say, 500% over that limit, you could still get a pretty meaningful tax credit to help cover your premiums. However, starting in 2026, if you are over 400% of that limit, you get zero tax subsidy. This is what I referenced earlier as the subsidy cliff. This means that you would be on the hook to pay for the full price of the plan. That's a massive deal. That means that if you are too aggressive about doing Roth conversions, for example, or drawing too much income from a specific retirement account, that means your health insurance costs could potentially skyrocket. And to really drive this point home, let's just look at 2025 and pretend this subsidy cliff was in place now. So let's say that you are 55 and married and your income puts you at 401% of the federal poverty limit. So we're talking just a couple $100 over that 400% limit. Without the subsidy cliff, you get a premium tax credit of $10,187 per year, which drives your monthly insurance costs down to $581 a month. However, if this subsidy cliff was in place now, that would mean you would get $0 in a premium tax credit, which means that this couple here would be paying full price for their health insurance plan at $1,430 a month, all because they went just $1 over that 400% limit. So this subsidy cliff, guys, it's no joke. If you are not careful with tax planning in 2026 and beyond, you can see how you can accidentally triple your health insurance costs. Now, if you are someone wanting to pursue early retirement before 65, or heck, maybe you're already retired early, Are you going to have to go back to work just to get cheaper health insurance? The answer to that is your tax plan really needs to be on point here to thread the needle. So for example, if you have a Roth, an IRA, a brokerage account at your disposal, we really need to think about which accounts we're pulling from to generate income. If you have investments that are generating a lot of income in a brokerage account, you need to consider the impact of those investments on your subsidies. If you're doing Roth conversions, now we need to weigh the pros and cons of doing them and how much to actually convert. All of this we'll be covering more in depth in a case study in a future video, but if you need help creating a retirement plan that covers these issues, get started today by taking our free assessment that you can find in the link below. Hope you enjoyed today's episode, and I will see you next time.